Welcome to the Deep Dive, your shortcut to being well informed. Today is August 21st, 2025, and we're diving into the global financial markets. Our mission, really, is to unpack what we're calling the pre-Powell pause. You know, that kind of collective holding pattern you see across markets. Everyone's waiting for the Jackson Hole Symposium.
Especially Powell's speech on Friday, yeah. That's the big one.
Exactly. Global central bankers are gathering, signaling policy shifts, but all eyes are on Fed Chair Powell. We want to explore, what's driving this caution, what it might mean for you.
And it's fascinating, isn't it? This singular focus on Powell has created, well, what traders call a low-conviction trading environment.
Low conviction.
Yeah, basically market participants are really hesitant. They don't want to make any big directional bets right now. Everyone's just waiting.
So this low conviction thing, it explains the quiet markets we're seeing, like the static U.S. equity futures, mixed trading in Asia, lower European bourses. It's all pretty muted.
Precisely. It's muted.
But is this waiting game, is it smart defense, or are people leaving opportunities on the table?
That's the million-dollar question, isn't it? And you see this caution playing out in specific ways, too.
How so?
Well, look at the recent wobbles in some of the big AI-driven tech stocks. Mega caps showing some weakness.
Right, the market leaders.
Exactly. Maybe concerns about valuations or, can that rapid growth keep going? But the broader market's been a bit more resilient underneath.
Oh, split there.
Yeah, split. And it goes beyond tech. We're also seeing this really significant divergence in the latest economic data, like the European flash PMIs.
The early look at business activity. What are they showing?
A widening gap. Manufacturing sectors are struggling quite a bit in places like Germany and Japan. Contraction territory.
Okay.
But services, they're holding up much better, sometimes quite resilient, like we saw in the UK data.
So manufacturing down, services up.
Yeah.
That sounds like a two-speed economy?
That's exactly what people are calling it. Manufacturing might be getting hit by, say, tariffs or shifts in global demand, while services keep chugging along.
That must make things incredibly complex for central bankers, trying to set one policy for an economy pulling in two directions.
Absolutely. It's a genuine challenge. If you're invested in manufacturing-heavy areas, your experience is totally different from someone in services. How does a central bank navigate that?
And that leads right back to Jackson Hole, I suppose. They have to grapple with this, right?
They do, and not just the two-speed thing, but also longer-term structural shifts. Think about aging workforces or how AI might impact productivity down the line. How does that feed into long-term inflation, long-term interest rate?
Oh, yeah.
It's like a high-stakes poker game. Every word, every piece of data gets intensely scrutinized for clues.
Speaking of data, I heard there's also chatter at Jackson Hole about a data quality crisis.
That's right. It's a growing concern.
What does that mean exactly? Like the numbers aren't reliable?
Kind of. It's more about declining survey participation rates. The surveys used to build key economic indicators. Fewer people are responding.
So the accuracy might be questionable.
It impacts the accuracy, yeah. Imagine trying to steer the economy using a map that might be, well, a bit blurry or outdated. That's the challenge they face.
Okay, but isn't there a risk here? If they focus too much on, say, long-term trends or data issues, could they miss important short-term signals? How do they balance that?
That's a really sharp point. Actually acknowledging these data quality issues, if they do it publicly, it gives them a bit of intellectual cover.
Cover for what?
To be less reactive to maybe noisy monthly reports, they could argue for more patience, focusing on the underlying trends instead of jumping at, say, one soft data point and cutting rates immediately.
I see. So it could support a hold steady approach.
Potentially. And complicating things even more, look at oil prices. They've been creeping up again.
Right. Crude's been rising.
That adds another layer. Cutting rates when energy costs are going up, that could look counterproductive if you're still worried about inflation. It strengthens the case for staying, well, maybe a bit more hawkish.
Okay, so let's try and wrap this up. What does this all mean for you listening? The main tension seems really clear. The market is strongly expecting rate cuts. You see it in the pricing, like over 80-90% probability for September.
Yeah, very strong expectations.
But then you look at the Fed's own words, like the minutes from their July meeting. They still sound mostly worried about inflation sticking around.
You've absolutely nailed the crux of it. That tension, that gap between market hopes and Fed caution, That's driving everything right now.
And against that backdrop, we have Walmart reporting earnings today. That feels pretty significant.
Oh, definitely. It's a critical, like, real-time pulse check on the U.S. consumer. You could almost call it a swing vote in this whole economic debate.
A swing vote? I like that. How so?
Well, if Walmart comes out strong, it sort of empowers the Fed's argument to hold steady, right? Shows the consumer is resilient. But a weak report, that would add weight to the market's call for easing.
Makes sense. So looking ahead, here's something to think about. Consider this two-speed economy. We talked about manufacturing lagging, services holding up.
Yeah, and the data quality questions.
Right, and those discussions at Jackson Hole about the data maybe not being perfect, how might these underlying issues, these nuances, change how you interpret the economic news you see every day?
How might it influence your own financial decisions going forward?
Exactly. It's not just about the headline numbers anymore, is it? It's about understanding the currents underneath. Something to definitely mull over.